bigger investments are going to be 25K is kind of a minimum. Some people will let you do a half a share, or 50K for a lot of those. So I would say get educated and start putting money away into these accounts so that in a year or two, and then educate yourself, in a year or two, you would be able to invest.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Janice, thank you so much for taking the time to be here on the show. This is a long time coming. It's been, months ago now for us to, get the right schedule in line for us to be here. So I'm super stoked to have you. As we're going to get into, you've been working with professionals and been in the industries of, tech for quite some time. In fact, you've been investing for over 30 years, experience in rentals, remodels, apartments, fundraising through IRA investments, running clubs, meetups, offering courses, which I saw as well, and coaching students.
Yeah.
I also saw you just had a guest speaker on for one of your meetups around infinite banking concepts as well. I'd love to hear more about that, but maybe on another episode. But, one of the things we talked about for this particular episode, this time for you to be on here, since you do have experience working with tech professionals and employees, I thought you'd be a great person to, lend your experience, lend your voice here to sort of have a conversation for those in our industry, tech industry, to have this conversation. And so, with that in mind, could you just give us a little bit of your background in your words about your experience so we can get to know you before we get in today?
Absolutely. And Steve, thanks for having me on your podcast. I've been investing for over 30 years, I guess, because I kept my first condo, and that's just how do you get started? Keep it, rent it out, move to the next property, right? So I'm a nationwide real estate investment coach, and I founded EnergyWise Properties really to do flipping and hold my rentals. But I also founded a capital raising company, which I'm doing now. That's more for the passive investing, and as well as training people and teaching them how to invest themselves. I come from the biotech industry, and so because of that, I wanted to help people look at what you do with the different kinds of tax-deferred and tax-free accounts that you might have, which are already in the stock market. How do you move those into real estate projects? So I've owned apartment buildings, flipped properties, invested passively, just a number of different asset classes in real estate, been a little bit involved with mobile home parks too as well. So there's a lot of different ways to go, and each one has its own pros and cons and a certain amount of work that goes with that.
Yeah, awesome. Outstanding. I mean, like you said, different asset classes, they each have their own unique characteristics. And not only that, but they're different place in a portfolio to be built as well, right?
Yes.
And so, you talked about starting with your own rental, your own condo, and working through each of these asset classes over time, over these last, couple of decades, which is really awesome because it does take time to learn, make mistakes, practice, reflect on it, etc. Right? But this might sound really obvious, but I'd love to hear it from you. Just a couple of the reasons why real estate investing is something maybe that you're after first, and maybe how did that change over time?
Okay, great question. Yeah. I mean, the easiest kind of real estate investment to have is the type that you would live in. So, initially when I was developing my career, getting my PhD, working in biotech, I kept houses that I had bought myself. And, everyone has to start somewhere. I kind of look back on it and laugh. I had a couple of rentals while I was working and there was easy because the people renting them were like me, they lived in those areas too. And I hadn't gone into specific types of lower income deals or anything like that. until I got laid off from biotech. And that was kind of the
Mm.
wake up call was, oh, I got laid off. Now what? I
Mhm.
don't want my financial future to be dictated by someone else with 2 weeks notice, if you even get that these days.
Yeah.
So I looked at going to real estate, reading books first. You have a great bookshelf behind you there. And that wasn't enough. So then I went to clubs, then I took courses. And I'll say, if you're a beginning investor, there's things you just don't know at first. And the funny one for me is everyone talked about a deal. I
Yeah.
literally didn't know what a deal was because I had bought properties that I lived in, then I moved on and rented them out. And I didn't know, how do you calculate that it's a deal? Like, that was just a
Right.
vocabulary word I had to learn. So, even the most experienced of us have to start somewhere. So that's the big tip of don't be afraid to ask the right questions when you first get started. There's a lot of education out there and many different ways to go. I like people to start with something that fits with what they already know, because what happens is the things that you don't know look super sexy and you want to get into them, but you really have no experience.
Yep.
If you have accounting experience, you start with one kind of real estate. If you have contracting experience or you're handy, you start someplace else. It seems boring to us because we
Mhm.
already know that area, but that's where you're going to have the most success.
Yeah, yeah. It's funny. I had the same experience with the deal as well for
Mhm.
with the word deal. But anyway, it's just funny that one pinpoint. But when you were talking about how you started, you got some different houses. So you bought a house, I think, moved and started renting that one out first, or the condo especially. And it was just kind of a model, right, for you. Was it? And so from a goals perspective, was it just getting cash flow at the start? Was that the primary reason for investing?
Um, well, I was, you're working full time and raising kids or whatever, and just didn't, yeah, I wanted the cash flow. And I knew that I had bought them at a pretty good price. Somehow my timing just happened to be low
Mhm.
times in the market. And yeah, I just wanted those things to start paying themselves off. So at the time, when I got laid off, it was like I had one where I lived, and I had one in Southern California, and I had one in Hawaii and one in New Jersey, because that's where I'd been to school. And
Uh-huh.
so I was spread out and didn't really, understand that concept, but they did well because they were in, the nicer neighborhoods that I had lived in.
Got it. Great. And so that makes sense. And so you decided to keep them and rent them out. They were in the good areas, the right time, thank God. And they did continue to cash flow.
Yeah.
Um, and so, but that was was that the primary reason first to keep them, to continue to hold on to them and to cash flow?
Right. I mean, I had cash flow already, because I'd bought one in like 89, and then one of them wants 93, 94. So they were already worth more than I'd paid for them. And the cash flow, I wasn't every once in a while I'd have to add a little bit of money to it, but I really didn't add that much to them. And then when I would sell them, then I would renovate, before I sold them.
Okay, got you. Got you. I was just trying to understand a story of how your mindset of why you would invest changed over time, because you've been through these different asset classes. You've done, flips and then apartments.
Mhm.
Was it sort of organic of, well, you could do one at a time, but then, hitting a scale factor? Is that why you went, found apartments and other asset classes as well?
Well, yeah. So when you're working, it was like cash flow and appreciation, and my job, certainly covered what I was doing, and my husband's as well. So I didn't have to worry about the investments, and I didn't even have time to learn about them. It was just like a normal person, like have a rental. That was how, but then when I got laid off, I was like, how can I really grow this experience that I have already? And that's when I started acquiring. I'd say in the 2 years after I got laid off, after getting the education,
Mhm.
within 2 years, I had added 17 properties, which included 60 units
Wow.
altogether. Yeah.
Got it. And you were definitely going for for, it sounds like, replacing income at that point too, then, right? There was certainly
Right.
cash flow as a primary thing, because you can't eat net worth, right?
Right. Yeah, exactly. Well, you can when you refinance, but that doesn't happen that often. Yeah, so I did some 1031s to
Mhm.
move the money from the appreciated properties into more cash flow properties, and used pretty much any method I could find to acquire all those properties.
Awesome. Cool. Well, I just wanted to get a sense of the background. Of course, we're here to learn, some other great strategies and tactics that, about using the tax deferred accounts that we have. And so I just wanted to,
Mhm.
really point out that, as we're talking to tech professionals, it's, we want to maybe supplement the income first, looking at cash flow, right? Using our capital to get cash flow. And over time that can change, but supplementing or complementing, cash flow through something like active or passive investing.
Right.
Of course, this is path to passive. So let's talk about a little bit of that. Walk us through at a high level, what active investing is, what passive investing is, and then let's go from there. How we can actually start using some of these different accounts.
Okay, great. So, very active investing would be wholesaling, where you're marketing to a lot of different properties, getting something under contract, and then selling it off to someone else. And that's a very active, that's getting yourself a job. That's
Mhm.
another job. Another job in real estate is flipping houses. So you created a job. Instead of selling that house to someone else, you then remodel the whole thing. Not yourself, but you hire the contractor. You're managing it. You're getting the money. You're worried about when you're going to sell it. Managing the contracting is a job in itself.
Yeah.
So that's an active type of investing. Moving towards passive would be, you have the rental, where really the rent comes in every month, but you're managing that, you're doing repairs, and you're paying some of the bills on it. So that's very much passive. That's the landlord concept that a lot of people have about investing.
Yeah.
And then the most passive is when someone else runs a project and you've basically put money in. When I was adding to my portfolio, I wasn't really using IRA money at the time. I didn't, I'd learned about it a little bit, but I didn't do that till much later, when I started flipping and then getting into the the IRA accounts, where you can passively invest and you just choose the project and wait for the return to come in, but you're not doing anything on the project.
Got it. Appreciate that. And I just wanted to add some of that on top of this too, that,
Mhm.
active investing, I mean, you could in theory make a lot more money, but it is a lot more time as well. Right. And so I totally agree, managing contractors and all the different vendors to, do a flip. Like, how much time did you, just ballpark? I know it can vary based on whatever the project is, but how much time do you think you're really spending on active types of real estate investing?
Well, by that time, I was a full-time investor. So when I was doing flips, first you had to find the property, then do the budget, order materials. I mean, probably a project could take 20 hours a week for you when you're managing it actively, making sure permits are going. Definitely every Friday you're paying your subs and all that. You're going over there with checks, and they're changing their hours.
Yep.
Oh, I forgot I went to Home Depot to pick up, and it changes. So you have to be flexible and adaptable to that. One of my partners at the time was like, "Why don't they just write all this out in Excel?" And I was like, "If they were good at office work, they wouldn't be contractors." Just tried to explain that to him, but he was an
Yeah.
office kind of guy. So he's just like, "Why? Why is this happening every Friday? Just bring the checkbook, okay, and write the
Right.
checks."
Yeah, we all have different skills and experience, certainly. And on the passive side, like you said, doing some investing, certainly have a property manager too if you're doing the landlord thing. But all the way on the other side, if you have someone like, a what we call an operator, right, a real person that runs the project that you can just collect those the mailbox money from, so to speak. So
Right.
got it. Thanks. So that's both sides of the spectrum. And so
Well, let me just add one more thing about, you brought up property managers. You manage a few of them yourself, but certainly anything out of state, or if you have an apartment building, I had a property manager for my out of state investments. In fact, I still do. And then if you have a large enough set of units, over 20 units in one location, you really
Mhm.
need an on-site person, even if they're someone who lives there, you're paying half time. Once you get up to 50 units, you really need an office and paying someone full time to deal with all the filling up, leasing up, and repairs and things like that, or even a half-time handyman just to make sure things run properly. So I certainly did that and had my own employees for a while, because you can't run those properties yourself.
Right, certainly. And just for clarity for the listener here too, you're talking about what you were just talking about, having multiple units in one location, right? Much bigger than, a single family home, for example. I mean, most
Right.
people aren't going out there and acquiring 20, 50 plus units on their own. Maybe they are, right? Especially here in tech, maybe they are, but that's certainly not what this episode is going to cover. This is what you're talking about is, the sponsor of a bigger project goes out to understand the market, get the criteria, and do that whole acquisition process. But that the LPs, limited partners, and if you're listening to this, I've covered this in different episodes, that can invest with a sponsor team is one of the methods we're talking about. So the LP, or that passive investor, can invest with that team and then get the returns. So let's talk a little bit about IRAs and HSAs. So I there might be some people listening that are thinking, hey, I've been in tech for a couple of years here, and I sort of know what I have, what I don't, what I and maybe I'm not quite sure what I do have. What are some of the questions that they should be, asking? They should be looking for when we talk about IRA and HSAs. Like how would they know they even have one?
Okay, great question. So if they're still working for a company, they really have a 401k. They might have a Roth component with it. So the basic 401k, you put your money in before taxes, and you get a little bit of a tax advantage to that. And then if you have a Roth component, you actually put money in after you've already paid taxes on it. So there's two different aspects to that. And then same with, so that's the 401k. And if you work for a nonprofit, it's 403b, I think is the number. HSA is a kind of a new thing, been on the market mostly the last 5 to 8 years. It's a health savings account, and it took the place of the flexible savings account, which you had to use by the end of the year,
Hmm.
just like your childcare expenses. But the HSA is like a long-term account. You're allowed to keep money in it and accumulate. The limit for families is in the 8,000 range right now, and an individual is 35 to 4,000, depending on the year that you listen to the podcast. Look that up. Each year it goes up a tiny bit,
Yep.
and you're able to keep those. And the reason I love to talk about that for people, in your age bracket, Steve, is you can use the money now. This is not a retirement account. You can use it for your health expenses.
Hmm.
And the other cool part is that it's not tied to what your health insurance is going to approve you for. It's a standard list that the federal government puts out. And if whatever you need to do goes on that list, whether it's dental, eyeglasses, LASIK,
Hmm.
whatever, you're allowed to spend your money on that.
Got it. Are
Yeah,
you, or do you bring this up too? Are you saying that we could potentially invest in real estate with HSA?
absolutely. So it acts like an IRA, and I can give you some specifics on that. So yes, you can invest it, um, not while you're working with your employer,
Hmm.
but if you transition to another employer, then you get to invest it. When you're with the employer, you can invest it in stocks like normal 401ks. Mhm.
Got it. Yeah, I think this is such an interesting thing, especially for the listeners here, because they may think the items you just listed out that it's only health savings account or health related items, right? And
Mhm.
um, you know, not to get too much all over the place here, but it's also true that any information you can give about, the possibility of opening up an HSA with a different type of custodian and maybe using that as well. Is that an option?
Right. So what happens with IRAs, just the broad overview is IRAs, it's a 401k with your employer. As soon as you leave that employer, you're allowed to roll it to another custodian, no tax consequences. You roll that money over and then it becomes an IRA. What most people don't realize is when you retire from your last company, it's going to roll over to an IRA anyway. They
Mm,
don't keep it with the 401k. You still have to roll it over. Same with the HSA. If you leave that employer, you can roll it to a self-directed HSA with the same custodial company or account. Um, there's and in order to have that kind of health insurance, though, you can't have that account if you have a HMO. It has
mhm,
to be a PPO, and that's offered, and it has a um, that kind of insurance has a deductible that's around $3,000 deductible.
mhm.
And that's why they allow you to put it away. Now, some employers either match part of it or they put in like the whole amount that you could contribute as a single employee and they just put it in the account for you. So you don't even have to worry about your deductible.
Got you. Okay. So just sort of summarizing this at a high level, that both of these types of accounts we're talking about, well, really, we're talking about three different ones, but you have them likely if you're employed, right?
Yeah.
If you're still employed, you have a W-2, you are going to have these types of accounts, the 401k, uh, you know, an HSA
Roth.
likely, yep,
Mhm.
or that Roth component, and uh, so you're going to have these. But something I think that was interesting that you mentioned in our previous conversation, I wanted to
Mhm.
bring here too, is that and I know too, that there are people that bounce around in this industry from job to job, right? So I don't want someone listening right now to think, okay, well, I'm employed, I can't use this to invest, so why am I even listening to this, right? And
Mhm.
so what about the people that have hopped to different jobs every 2 to 3 years? They have other accounts that they might just be left behind somewhere. What do they do with those?
Mhm. Right. So if you are employed and the bulk of your money's you're still in your 401k, you can borrow against it. You can borrow money outside of it and invest however you want with that or buy a car, whatever it is, you can borrow from your 401k. Once you leave a company, those those accounts are set free essentially,
Hmm.
and you then can roll those into an IRA that's self-directed, and you can combine ones from several years and roll it into an IRA, and then start self-directing into real estate yourself.
Awesome. Perfect. So what you're saying is that if I have worked for company A, for some tech company for 5 years, and I've been, contributing to, I don't know, 3,500, a year or something for those 5 years, and then, I moved to a different company, that previous 401k is now available to roll over into somewhere else, a
Mhm.
custodian, or just a
Yeah.
company like a Fidelity or whatever, but it is specifically around self-directing funds, and then I can invest in real estate with that.
Right, right. I mean, if you go to a Fidelity, Vanguard, or Schwab, it's going to be in stock, but
Right.
there's lots of other companies that you can do that with. Now, that's um, the caveat is that often when you get hired by a new company, your HSA in a sorry, your the people HR, sorry, I should say,
Yes. Yes.
the HR person will often ask you to roll it into the new job. So if
Mm,
you can resist that temptation from HR and say, "No, I'm good. I got my own thing going over here," then it's free to do with what you want after that.
got it. Got it. Great. And yeah, there's perfect. So let's just keep from the story perspective here. We're looking at how we can if you want to do an active investing, that is a different episode. Here we're talking about what we can do to invest passively in different real estate investing projects, using funds from different retirement accounts, from rolled over IRAs and HSAs for that matter. So let's talk a little bit about, you've done a lot of coaching, you've done a lot of, these meetups, the clubs, for quite some time here too. I'd love to really understand what the conversation looks like for, someone that is coming to these meetups the first time that you're talking to, right? Like how do these conversations start with you?
Right. So I have people who sign up for my meetups, and I think there's usually a couple questions, and they'll say, "No, I don't even have any self-directed accounts. Like, what do I do? How do I get started?"
Yeah.
So it's really good to learn about the various companies that do that. There's at least 25 to maybe 50 companies in the US, they're all growing all the time,
Wow.
that do these custodial accounts. And then people say, "Why haven't I heard about this?" And I go to meetups, biotech meetups, and they'll be like, "There's that can't be right." It is, because I didn't just make this up. It's
Sure.
it's written right into the IRS code that these accounts are available, right?
Yeah.
And in fact, when you finish working, you will have an IRA that's self-directed, but most people just, throw it into Fidelity or something.
Mm.
So people can look at those accounts. They're just not even sure they exist. And then they learn that they can roll it in there. And they do work, they do function best when you are doing passive investing with them.
And
So I can
and
tell you why.
yeah, they do function best with passive investing. Can you elaborate on that? How do you mean that?
Yeah. So, say you're running a rehab, but you're using IRA money. And first of all, you can't really do that. I'd have to lend it to you, and you could lend it to me.
Right.
There's some rules that are set up where you can't really put your own IRA money into your own deal. Like, you can't be the operator and use your own money
Hmm.
for it, unless you do something different, which is setting up an LLC, and then it's called a checkbook LLC, and then you can pretty much run your own flips out of that. And the reason is because every time you pay something, the money has to move from the custodial account out to whoever you're paying. And so when you're actively running a project, there's so many expenses. Even just owning a rental property, you've got the taxes and repairs and things like that. So you're having
Hmm.
them cut a check every time. So if you're trying to do rehabs, you really want to do the LLC type, and that's not passive, because then you have control of the checkbook that goes with the IRA. So that's a whole nother conversation. But
Yeah.
passively, it works best. Say you go buy a property, Stephen, I'm the funder.
Hmm.
I'm going to wire you money at the very beginning to do the purchase. And nothing ever comes back until you start sending me either dividends, interest checks, or the final principal payout.
Hmm.
So I don't have to keep sending money. It gets sent once. And that's why it works well passive. That's
Got it.
really lending on a property. That's called a note, or you can invest with someone in an equity position.
What
So,
what is so I have a follow-up question there, but just for the contrast, um, having investing from these accounts, the IRA and the HSA, we'll just keep it IRA for now.
sure.
Makes a lot more sense from a passive perspective, because it really, you're saying it's just one investment out the door, and it's one time until you start getting checks in the mail, so to speak, versus
Right.
the active investing with an IRA or self-directed IRA is not the advantageous model, because there's much more outflow that needs to happen. So it's much better from a passive perspective to just invest once and then get those checks back into that same account to grow that self-directed IRA. Is that what you mean?
Right. And so to make it simple for someone, say you're
Hmm.
you're purchasing a house to fix, and you only talk to the bank once. Your
Hmm.
IRA is like the bank. You get the loan from the bank. The bank doesn't send you any more money after that. Like,
Right.
they're done. now you're using your own checkbook to do all that work. And so the IRA acts as a bank. So that's why it works much better as a, a standard IRA works much better as a lender and as a passive investing
Perfect.
vehicle.
Got it. And so you also mentioned, so following that same model, right? Your SDIRA, your IRA, you can look at it as a bank to go fund other, fund investments by your own direction. That's what self-directed is. You self-direct, like direct this cash to your own investment that you want to. You're
Right.
using a flip perspective, but you also mentioned an equity position. Can you elaborate what that means and what like types of investments you might be thinking of here?
Right. So those two types are the same whether you're using IRA or just your own regular cash that's not in a tax deferred account.
Okay.
You can either invest and be getting, it's a note with a specific interest rate, but you won't get any more than that. So say you're going to be getting 9% plus 2 points or something for lending to someone. You're guaranteed to get it, not guaranteed, but that's the money that will come in, but you can't get any more.
Mhm.
Whereas you could put money in and say, I'm a 50% partner, and then you're you have an equity position. You could lose or you could gain. So that's the equity position. Think of that as you're partnering with the person who's the operator, but your IRA just did the funding of that. The IRA companies don't like that as much, but it's certainly possible to do and have an equity position.
Mhm.
If you invest in larger projects, like apartments, they'll
Mhm.
often have kind of a blended approach to that, and I can go into that later.
Okay. So it's equity being that form of ownership, right? And we've talked about capital. I've talked about capital stack before, but in this case, it's holding a position of really pretty much at the top of the capital stack, right? Like you said, you could lose it or you could get a lot as well.
Right.
Got
Right.
it.
But just think of, the banks always get paid, they get their interest. If you're just doing the straight note and lending out of your IRA. So lending it comes back as interest. If you're partnering, then it's an equity position.
Got it. And, uh, so just to sort of recap to where we're at so far, it's,
Mhm.
you have these different accounts. If you're working right now, you have your W-2, you have, your IRAs and your HSAs so far. But like you said, if you have previous employers and you have these accounts that are released, go roll these over into a different custodian, different company, out there that will allow you to invest in different assets, right? Like real
Mhm.
estate.
Mhm.
And so that's where we're up to right now. You can then be able to direct these, the funds in these accounts to
Mhm.
get you more returns. And that's what we want. And one of those things, like you're talking about with that note, is actually getting cash flow as well. And so
Right.
um, so, sounds pretty good. Sounds pretty good because, these accounts where you weren't getting anything from before, we can now start to get cash flow. So, it makes enough sense to me. I'm actually doing this as well. But, talk to me about, again, we're having this conversation at the meetups. I mean, you know, as you're talking to someone, what are some of the other questions that come up? Is it like, great, wow, I can do this. But like, can I do this? Right? Like, am I going to be successful? Is this a scam? Is it, I don't trust myself to do this? Do I need help? What are some of those other things that pop up too?
Right, right. So the first thing is that getting people to just move their money into the account, and then once it's there. So there's two things to look at. You need to vet the project that you're going into, and you need to vet the person who's running the project.
Oh yeah.
And I kind of flip it around when I train people. I say, learn to vet the person first, and
Mm,
then look at the project, because sometimes people look at all the projects and then they sort of skip that part and they invest with someone who is really not going to do well
yeah.
with that project.
Yeah. Yeah. So been there. uh, so tell me about some of the questions that should be asked, right? I'm a new investor. You're coaching me through well, I'm coming to your meetup. I'm learning about this for the first time. I can roll over money. Great. You're telling me I should, vet the people, vet the deal and the
Mhm.
deal, right, the project, and also likely the market as well. That might be a third one too, right? So
Absolutely. So people start with private lending often when they've flipped houses themselves, or they have money and they'll invest in someone who's flipped quite a few houses. Like, don't just go with your friend who's never done it before.
mm,
Go with someone who's got a track record, and then you're investing. Maybe you don't have enough money for the purchase, but you have money for the second loan. Everyone's familiar with the first and second on their own home. The
mhm,
second is really supplying the rehab money, and you can charge a higher interest rate because you're not in first position. So that's where a lot of people start. They may be lending 50,000 for the remodel part of a house that the person purchased either with a bank loan or with another investor, or they bought it themselves, or they used a hard money loan, but now they need to borrow money for the remodel.
got you.
That's
So
kind of a very first step, and you're lending, and it's a note. So the note has a specific interest rate, and then you always want to record either the mortgage in certain states, or other states it's called a deed of trust,
mm,
with the county that says that you lent money. What that does is guarantee that person cannot sell the property, because when the title company looks it up, they'll say, "Oh, there's a deed of trust on this, or there's a mortgage on this.
mhm,
We don't know the terms of the note because you never record those terms, but the deed of trust will say, "Oh, give us a payout amount. How much should you get paid when this person wants to sell the house?" And that's how you guarantee that you get paid. So never do it without recording something with the county.
absolutely. Yeah. Title company will definitely see that. I've seen that a number of times, a clouded title, et cetera, right?
Yeah.
Um, what are some of the questions that should be asked for, the people you talked about that are running the project, and then maybe a couple
Okay.
questions that come to mind around, knowing if it's a good project as well.
Right. So, first of all, how many projects have they done? How many successful? Have any gone underwater? Do you put in your own money to cover it when it goes underwater?
Yeah.
That sort of thing. Because really, if you've lent on a note, they need to pay that. Um, and I've seen, private investors say that, and they say, "Well, I know the operator's going to lose money on it, but they've got to pay me." So the operator might be going negative in
Hmm.
what they put into it, but the bank, and your IRA is the bank, you're always getting paid. So I always look up the person, and I'm not going to give different specific names, but there's a number of websites where you can actually run a report on the person, and you want to check the county court sites, and
Hmm.
even the state court sites, to see, has their business partner sued them, or have they been in lawsuits before. And also, just you're kind of running their credit. It's almost like screening a tenant, but now you're screening the operator.
Right.
There's a number of different sites you can do that. So do that first, and then if that doesn't look good, don't even analyze the deal. After that looks good, then go look at the deal, find out how many deals, ask to see, um, some of the deals, or give, the address. You can drive by and check it out.
Hmm.
Ask to talk to other people that have invested with them before.
Yep.
So they really need a track record. A lot of people start of, "Oh, my first money came from friends and family." Yes, that's great, and that's why it was friends and family that invested with them.
Yep.
You, as an outside person, want to see that they had a track record with the friends and family before you invest your money,
Yeah. Yeah.
because they'll
And
likely pay the friends and family back first.
yeah, that too, certainly.
It's
Yeah,
happened to
those
me.
are great calls. So, just like anything we do, especially in tech, right? Due diligence, and a couple different ways to do
Yeah,
that.
yeah,
The person, I mean, sage advice, certainly. Always make sure you know who you're going to business with, for sure.
right, right.
Um, got it. So rolled over the accounts, starting to look at deals, look at people, really, right? And then what the successful projects were is like, okay, what have you worked on before, right? Like, how do I know, right? What does the portfolio, so to speak, the resume of investing look like? Got it. Are there anything else that comes to mind? Common questions that you'll hear from newer investors around. Maybe they start to learn more and they start to get their internal confidence. I'm like, okay, good. Like I know enough. I'm just about ready. But what about this one other thing? Anything else come to mind?
Well, they need to know what documents. They also need to negotiate their terms. And people,
Mhm.
what's terms? Terms would be the interest rate, the length of the contract. Is it going to be 6 months or a year? Um, and then, how's that going to be, recorded for sure. Um, and then and really right now we're just talking about simple loans on a property.
Mhm.
Sometimes people loan on a rental, and then the person's going to refinance and pay the person back that way. That's the most simple deal, is on one house, one unit at a time. We'll get into some of the more other asset classes where it's more passive.
Got you. Great. Yeah. Cool. Um, So expand on that. What are some of the other asset classes and that people could invest in?
Mhm.
And how what is a good way that maybe you've coached through doing it from a passive perspective?
Okay, great. I did think of one other question. When you're choosing the custodial company, I mean, you might want to. They have a lot of education on their website, but it is helpful to choose one that's in your time zone. And
Mm,
the reason for that is they have a cutoff point at 3 p.m. Almost all of them do, to get a deal done. And if it's not in your time zone, it's a little hard to keep track of. So, example, say you've submitted something and it's great, and they say just tweak the paperwork a little bit, and you give it to them on Tuesday, but it's afternoon, and I'm on the West Coast, and say they're East Coast.
yeah.
Well, now you missed their Tuesday deadline, so it counts as a Wednesday. And they said, well, we take 3 days
Yeah.
to review and get back to you. And your person's like, are you going to send the money on Friday? Like, what's going to happen? I'm like, it probably won't be till Monday because we missed the 3 day cutoff. So I
Sorry.
always
Yep.
try to stay in your time zone because it's easier.
Yeah. Good call, especially for the
Uh,
first, the
The
first
first, yeah,
rodeo.
yeah. And a lot of them now you can. It used to be that you had to go all the way to cash to change companies if, say, you wanted to change one later, but
Hmm.
now they'll let you move the deals with the account when you want to do that. So back to asset classes.
Hmm.
Um, so different asset classes have different ways that they pay out. So the most standard one someone would think about would be an apartment building, because you go house to an apartment building.
Hmm.
And the great thing about apartment buildings is people already live in them. So you usually get some sort of cash flow component. And always think, when someone says, I'm going to pay you this, think about, where's the money going to come from? That's
Yeah.
what I always want to know. Well, in an apartment building, it's obvious the money's coming from the rents. So you might get cash flow right away, kind of a lower level in the first few months, which maybe the deal's going to take 3 to 5 years. Then you get the upside when they sell it, but you're going to have sort of a base level of money coming in from the apartment. If someone's doing ground up construction, there's really no way that they're paying you while they're
Hmm.
constructing unless they're paying you with other investors' money. So it doesn't make sense if someone tells you, hey, I'm going to pay you this much from the minute we get started, because where would that money come from?
Yeah. Yes.
So think about that. Where does it come from? Same thing with flipping a house. Same with mobile home parks. There's rent coming in, so that's another one. Land development, there's no money coming in. There's money going out. So that's another asset class where you're buying raw land and then entitling it and getting certain permits and things set up so that it's ready to sell to a developer. So
Hmm.
there's really apartments, um, and then build ground up construction, land,
Mobile home parks.
Then mobile home parks, storage units,
Mm-hmm.
and then the other one is if someone puts a fund together with a lot of houses in one fund,
Sure.
or they put short-term rentals in there, and the
Mm-hmm.
other one is notes. So my friend he did individual notes a lot, and he now has a fund where that owns a lot of notes. So instead of you having one note that pays well and another one that doesn't, you can
Mm-hmm.
invest in his fund, and then your return is averaged over all the notes owned by the
Mm-hmm.
fund.
Yeah, that way you get this consistency, knowing that the fund is going to return some type of average blended uh, return, no matter what, right?
Right.
Yeah, yeah. That's we'll have to make you a quote on that, on follow money. Where's the money coming from? For sure, because value needs to be created. Value needs to be created, right?
Right.
Especially on the apartments or the multifamily side. You might not get a bunch right away, but as rents increase, the money's coming from somewhere. As the land is developed and there's
Right.
people in there, then the money comes from somewhere. So
Right. They'll often tell you, well, when you get started, there's a preferred return of 7 or 8%, but you may start at 3, but you're going to get that at the end. So say it may be 3 and then 5 and then 8, and it's going to stay at 8. We're in several apartment complexes in Houston where
mhm.
it's just like an 8% return, and it just consistently, they send the check right back into your IRA account. Then at the end, when they sell it or refinance, then you get the upside of, well, what else am I getting besides the 8%?
Right, the
So
preferred
so
return.
it's really an equity position because I'm getting um, something in addition to the percentage.
Right. So if I'm a relatively new listener, to investing, in general, I'm thinking, wow, Janice just mentioned a couple of different asset classes right away, and so Janice, you had me at I can roll over my accounts to somewhere else, but then you gave me like 6 different things right away. So what oh my God should I go look at to invest first? How would you answer that question?
Well, diversification's great, but you have to start somewhere,
Yeah.
right? So I think I would say most people understand apartments
Hmm.
because when people say, well, I've never invested or I don't really know anything, I'm like, where do you live? I live in an apartment. Okay, so you signed a lease before, you didn't create the lease, but you signed it. Or they say,
Sure.
well, I live in a house. I said, well, you already have a note and deed of trust, but it's with the bank.
Yeah.
So you've done something similar to investing. You just don't think about it that way.
You've been a customer. So if you would just flip it around, you
Right.
would know what the customer's gone through.
Right.
Yeah. Yeah.
Well, some people have negative feelings about these things because of the way they grew up. Because if you grow
Mm,
up in any household, unless you lived in your car your whole 18 years of your life, you
sure.
either lived in an apartment or a house, and your parents may have mentioned paying the landlord or paying the
Mhm.
bank. And so they may have mentioned it in a positive light or a negative light. So when the person thinks, well, I'm going to be a landlord, ooh, I don't want to be a landlord because my parents hated the landlord. So
Sure.
you have to start recognizing where you got these ideas from before you get started.
Yeah.
It's
Yeah.
unconscious.
And that is a whole different episode on
Yeah,
money mindset.
yeah,
And,
exactly. But
uh,
apartments, I think people understand apartments because, if they haven't lived in one, their friends lived in one. They visited apartments. So they understand money comes in, you pay the expenses, and there's money left over, or else why would the landlord own it, right?
yeah, yeah, certainly. So in general, I guess what you're trying to say is, start with what you know. That's what you right, and the business model is really providing a service, right? The bank provides a service, you pay the bank, or the bank or the apartment provides a service of housing for those that live in there. So
Yeah.
you can kind of think about it that way. And then branch out to these different, investment types, right? And so by that point, it's like, okay, cool. I can roll it over. I know what assets I should go look at a bit more. I can go and, ask questions, get smarter about those assets. Inevitably, I would think, some other things would start popping up, in the conversation, such as, well, okay, but I'm so busy because I work in tech and I fit 40, 50, 60, 70 hours, right?
Mm.
Um, uh, what do you say to not enough time, or, hey, I've only worked at this previous employer, the past one with my accounts that has like $8,000. Like, what do I do with $8,000? What do you say to some of those kinds of questions that pop up in the minds of who you're talking to?
Yeah, absolutely. So with a smaller account, you're going to work with a smaller, sort of newer investor. The more advanced investors start going, their projects get bigger and bigger. And,
Mhm.
I think you could invest a small amount on a note, but it would probably be like a note on a rehab or a tax lien or something like that, where it's a much smaller amount. The bigger investments are going to be 25K is kind of a minimum. Some people will let you do a half a share, or 50K for a lot of those. So I would say get educated and start putting money away into these accounts, so that in a year or two, and then educate yourself, in a year or two you would be able to invest.
Got it. So grow the accounts that way. Look at smaller investment sizes as well,
Yeah,
and you can sort of be squaring away your accounts while you get smart, so to speak, in how the investment in an asset works too.
yeah.
Isn't it also?
Well, I would say if you're going to grow an account, like when we started our Roth, say you don't have a Roth, but you want a Roth, you don't want to spend. So all these custodial accounts have to make money somehow. So there is a fee associated, maybe a
Mm,
couple hundred a year.
mhm.
Don't do that if you don't have any way to make income in the account. You can go get a Roth or an IRA at your local bank that has zero fees, and just start, doing that automated, once a month deduction out of your checking account. Build it up to a certain amount that's worth investing, and then roll it into the custodial account. So if you have zero, you can still start it that way.
Got it. Got it. Is it true that you can also combine funds from your SDI, your IRA, like a self-directed, and you can combine it to, finally have 10 grand or so, 10K in my IRA that I rolled over. I can, and I want to hit a 25K minimum. I can, invest 15 cash and combine it with the 10. Is that an opportunity?
Um, you have to be careful on that one. If you mean outside cash and the IRA,
Yeah.
you can definitely combine self tax deferred accounts. So in other words, sometimes the minimum was 75K, and we put 25 from my IRA, 25 from my husband's, and 25 from the HSA, and
Okay.
just put it all there. Um, Combining your own cash is almost like, and you'd have to check this with your IRA company. It's almost like you're giving your IRA an advantage because you didn't hit the minimum until you added your own cash. So you have to
Mm,
be very careful about any rules where you're giving an advantage to your IRA that is not there just by the fact that there's money in the account. So in other words, if you put money into a house flip, you can't go work on it yourself because that's sweat equity.
mhm. Yep.
Um, and the IRA company owners really spend a lot of time going to conferences and figuring this all out. I would say the most extreme example that I can think of is someone wanted to buy a house with the IRA next to a house they owned with their own money. And to me, that sounded kind of normal. But when they found out that they're next door, the
Mm.
person who owned the IRA company, was probably a podcast I was listening to. They said that is going to give an advantage to your IRA because you can fix up the house next to it and make it better, giving more value to the house you bought with your IRA because the properties are touching.
Wild.
And that So, listen to them. That's why you submit your projects to them, because they've thought of things like this that us normal people don't think about.
Sure, sure. Yeah. And, great call. I mean, these custodians, they want to make sure everything is compliance. There's so much governance around financial services industry that, you can ask them questions and you're going to get educated for days. Um, so, uh, okay, great. So, questions to be asked around, you do the rollover, you have your IRA, go ask the custodian what types of things you can invest in, go look for, asset classes, like notes, like maybe mortgage notes or liens or things like that might have a lower dollar value that you can start with as well, right?
Yeah.
Um, what are some of the other things that might come up in a coaching session and a meetup of well Janice, sounds good, this all makes sense, but I can't because whatever.
Right.
um
Smaller amounts. So you can convince a friend to invest with you. Say, hey, there's a minimum and I want to invest with this person.
mm,
Why don't I throw in 10 and you throw in 15 with their account? And that's totally legit to do
oh,
that.
awesome, okay.
Yeah.
So then you would both you would partner up, I would partner up. If we're investing with something with you, I would have 10, maybe they'd had 15. You say the minimum is 25, but we can both go in with our IRAs to meet that 25K minimum as one investment.
Yeah, and that's up to the operator to decide. In other words,
Okay.
I might say, that sounds good because you're bringing that person, Steve. I didn't have to go find them or talk to them or, well,
Yep.
that's on you. And if you, want to bring in someone else with the deal, and I know that it's still going to be my minimum, I might be okay with that.
Perfect. And then based on the pro rata or just the percentage, right? It just any dividends, any money back from it just gets split based on whatever was put in then, right?
And that's why we hire accountants.
Love it. I agree. Awesome. I want to be respectful of time. I'd love to, tell me a little about these meetups and clubs. I've mentioned this a couple times now. You've been, hundreds of people at some different courses. I know you've been doing this for like 6 years or so. I think it was last March, with, the meetup. So give me a little bit of information. What does this look like? I think you have an expert lounge as well. I've been meaning to
Yeah,
come down in San
absolutely.
Diego,
So
but
So you can Google, anyone can Google real estate investment clubs or REIA, real estate investment associations, and look
Mhm.
up a local club in your city or area. And if not, you can also find, if it doesn't have one, a REIA club, you can also find them different ones on Meetup. So there's a lot of clubs in Southern California and in different cities. And when I go to a city, if I'm there on a meeting or a vacation, I see if the club's meeting. And I've gone to the one in Detroit because I had um, a lot of investments in Michigan.
Nice.
I've gone to the Boston RIA where if they're online, I'll go to the club online because,
Mhm.
why not? It's on Zoom.
Sure.
So when I noticed that they teach you a lot about how to be a landlord, how to do documents, how to remodel properties. And there
Mhm.
wasn't as much focus on how do you raise the capital? How do you
Mm.
raise money? So that's how I chose what my club would be about, because that seemed to be short shifted. Or someone who's on stage speaking says, well, I have a guy. You know, everyone has a guy who has millions of dollars who funds their deals. And
Sure.
I know that when we were doing flipping, a guy came to us and said, my guy changed his mind and like went into crypto or something, right? So all of a sudden, all of his projects dried up because he only had one lender.
Oh,
So
man.
the reason I started my club, and I call it Private Lending Masters, and it's
Mhm.
on Meetup in San Diego, but we're on Zoom, so you don't have to be in San Diego, but that's our local area. I wanted to teach people, number one, the right documents to use, a note and deed of trust. I wanted to teach
Mhm.
them how to talk to people about investing, and say it's your deal, Steve, and you want to raise money for your deal. You're not asking someone for money,
Yeah.
because our moms told us that that's not okay, right?
Sure.
You're not asking for money. You're providing an opportunity for them to make money, and an opportunity that they can't find any place else because
Hmm.
they're not running that project. So changing people's mindsets into they're providing an opportunity is just a big shift that takes people a while because they go, I don't want to ask for money. Yes, you're not doing that. So
Right.
I have a lot of ways of having them practice scripts so that
Awesome.
they change their mind about that.
Yeah.
Oh, so the meetup, Private Lending Masters is how we meet. The Expert Lounge is something that I run for one of the bigger clubs where people can, during our networking part of the meeting before the meeting starts, I run what's called the Expert Lounge at San Diego Creative Investors Association. So
Cool.
people can come up to me and ask questions, you know, beginner questions or advanced questions. That's
Mhm.
what I'm there for during that 2-hour block, is to answer any questions they might have or refer them to a friend of mine who has the answer, you know.
Yeah, yeah. I mean, the networking component is so, I mean, is so important, and that sounds obvious enough. But it's been a learning curve for me too, especially when you're, competitive environment and you're used to having to perform and contribute, and it's all about the work that
Yeah.
you do. It, like, just like you're saying, it's a mindset shift, right? To go from not asking for money for opportunity, but not being the one to contribute on your own, but to do partnerships, and everyone has a different component. The operator, like you're talking about, us having something and bringing the investment, or knowing someone else who can, bring their 5 or 10 or whatever amount to go into to make a deal happen. It is so much more of an abundance mindset aspect, right?
Yeah, and what you just said about the tech people, I mean, we're used to doing Excel, being an Excel jockey, right? Analyzing things. So those people are good at analyzing deals. And one way to get the information is you could go on LoopNet, it's
Hmm.
loopnet.com, I guess, or CoStar,
Yep.
and download some just projects. They may not be the one you're going to invest in, but you start to see what kind of expenses occur when someone sells a property, or they'll have the past 3 years of the data for the
Hmm.
expenses for that property. I'm not saying buy one from LoopNet, but look at it. Just helps you analyze and gather data that you might not get otherwise.
Yeah, that's a great call out. It's an interesting source to go and see that, and the documents are there,
Yeah,
versus, single family homes are private, unless
there's
someone's going to
no
show you all
information.
this stuff. Yeah,
Yeah.
exactly.
How
So
much do they spend on property management? How much on trash? How much repairs? What are the utilities? It's all there in their disclosure documents.
yeah, awesome. Anything else you want to mention about the clubs or people, things that you're a part of and run?
Um,
Okay. Well,
no, I thought of one thing that we should touch on when people do invest that they may have not heard of, is whether they're an accredited investor or a non-accredited investor. So
got it.
certain deals you can be non-accredited, and the other deals you must be accredited to be in there. And usually they have a higher minimum.
Hmm.
So accredited means that you, a single person, make $200,000 2 years in a row. If you're married, it's 300, or you have 1 million in assets, not including your personal residence. So
Right.
then you're accredited, and you can kind of look at any deal that's out there. If you're non-accredited, you're going to work with some of the smaller operators or people like us with a big heart and say, we want everyone to come in. The minimum there is usually more of the 25K for those. So
Got you. And I think there's a limit on how many non-accredited investors you might be able to accept as well. It's usually like 35 or something, if I
35.
remember correctly.
Mhm, mhm.
Yeah.
And so that's why the deal can't be that big, because after you get past 2 million, you, or even a million, to between 1 million and 2 million, you're not going to get enough people to hit your goal if you have non-accredited investors that are only going to be putting in 25 or 50. So
Sure. Certainly. Certainly. Unless you're, yes. Yes, exactly.
so if you're not an accredited investor, you're not going to be in, a $3 to $5 million deal. And I
Yeah.
don't mean, I mean the amount they're raising. It may be a $15 million project, and they're raising 3 million. They're not going to let non-accredited investors in because they won't raise enough money.
Understood. And yeah, agreed. I have got some quick rapid fire questions for you before we close out. I'd love to get your thoughts on these. Um, and so, just sort of finishing out and then pivoting from the last topic, what's some of the things you enjoy most about, hosting the meetups and the coaching that you do?
Well, I really enjoy the networking. That's how I learned, and I enjoy um, helping people, training people. I mean, I have a PhD, so I learned how to teach and coach, um, and basically teach labs. So I think of it
Mm.
as a lab where you're just in that learning environment. And I think for me, just seeing like the light bulb go on in someone's eyes when they finally get something that, like, my superpower is taking a complicated topic and explaining it like kitchen science,
Yeah.
like, oh, it's how this works, something that they're familiar with. And they go, oh.
Oh,
So I just, I really enjoy that part of it. And,
awesome.
and
Yeah.
then coaching, I use very specific master coaching tools to get people over their fear of doing it and their analysis paralysis that most people have, especially in tech.
Yes, especially in tech. I don't know anything you're talking about there, Janice. Yeah, it's a key component though, right? I mean, learning strategies and tactics is one thing, but it's always some type of emotional thing or the fear or the mindset or what have you. So, invaluable skill, really.
Like, what if,
Uh,
what if, what if? That runs their brain.
yeah, yeah, yeah. I know. um, talk to me about advice you wish you had when you had first started. At whatever point that is for you, 20 years ago, 25 years ago, 30, something maybe that was really impactful for you 5 years ago, something that you would tell yourself that was you would like to share with others.
Well, I mean, every deal doesn't go perfectly, so some might not work out that well.
Hmm.
But you're going to have home runs as well. So don't do that one deal and then say, I'm never doing this again. Um,
Hmm.
most of the advanced people that I know that have been in real estate a long time, we've all lost money on something. So that's one tip. The second tip is you are going to lose money. And
Hmm.
would you rather spend the money on a deal gone bad or on coaching? So I say, get coaching, get the training that you need, because the coaching is going to cost less than the deal that went bad.
Yeah, yeah, and a lot less heartache and emotional roller coasters too.
Yeah.
Um,
Because people come to me for coaching because a deal's going sideways and they need coaching and training to get out of that. Like, I can look at it and say, okay, this is what we're going to do because I can see where things are not lined up.
yeah, yeah, it's so true. It's so true. There's, I'm sure we've all been there. It's like, oh, it's not that difficult. That makes sense. I can go do that. But you don't know what you don't know sometimes, you
Yeah.
know?
Yeah. Do you want to spend 10,000 on coaching or 25 just losing money? Right. Because
Right.
it's an expensive education.
But it's a lesson you'll never forget, hopefully. So I know you have quite a few resources out there. You have some different, ebooks that you're putting together. You have some different courses. You talk about the private money lending stuff too. I mean, we covered a bunch of topics, and there's. If I were listening to this type of material for the first time, I'm sure I'd have a lot of questions as well. So, talk to me where people can find you, best places. So make sure to get some of that in the show notes as well, of course. So it's easier to reach out to you. But for questions on the topic you talked about, where can people find you?
Okay, great question. So I have a like a link page called janicebell.me,
Hmm.
and that has a link to my club and a link to a couple of the other courses I do. It has a link to my YouTube channel, Wise Wealth University, and my, because when you go on Meetup, it's sometimes hard to find meetups in specific cities.
Yep.
So just go to janicebell.me and find those links. The next thing would be an ebook that I've written on how to invest your IRA money in real estate, and that's going to be at janicebellbook.com. So that's a good resource to have. I think that you had one other question on. Oh, another one that I think if you download the book for sure, you'll be getting email announcements. But I do a free webinars probably twice a month on Fridays, and those are at janicebell.live.
Mm-hmm.
But if you're already on my list for the ebook, you'd get that announcement. So
awesome. Any other parting words or things that you'd like to share, Janice?
Real estate investing is just a great way to grow your wealth. And, I don't know the percentage these days, but everybody who is wealthy has real estate. They may have not used real estate to get all their wealth. Maybe they had a company, but then they always invest in real estate because that's the passive way to maintain and grow their wealth going forward. So
yeah,
don't be
absolutely.
afraid, just get educated.
Awesome. Well, thank you so much, Janice. Appreciate you. Thanks for being here.
All right. Thank you, Steve. Thanks for having me.
Yeah. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.